Imagine you go to a tailor shop. You want a great suit, just like this. Okay, this is a good suit. Okay, you want a suit. Can you go to tailor shop and say, "Hey, I want a suit," and just go? No, your tailor, a good one, would say, "Okay, let me measure you. What type of fabric you need?" Have like he will ask you some questions to make sure that he will make a good suit that fits your expectation. This is exactly what we do in a financial world. There is a very, very important term called KYC, or Know Your Client. I think it's self-explanatory. What's know your client? The first thing that you do as a mutual fund dealing representative is you need to ask your clients, hey, how old are you? What's your goal? Like, why do you want to invest? Okay. When do you need this money? How is your risk profile? How much are you earning? KYC has different components. You need to know your client thoroughly so you could advise him or her in a best way. Okay? Know your client is all about those 6 components. Let's dive deeper and know all ins and outs about KYC. Let's get it done. Know your client, or KYC. We have heard this KYC a couple of times so far throughout the course. In this lecture and in this chapter, we're going to dive into details of KYC. What components does it have? What's the process of acquiring your client's KYC? In simple terms, let's define KYC. KYC, or Know Your Client, means understanding who your customer is before giving them investment advice. Okay, it makes sense. You need to understand who is your client, know ins and outs about your client, and then recommend something to him or her. What's the goal with KYC? The goal is to make sure the investments you suggest are right for them. Okay, and you need to collect important details about your client, like their financial situation and goals, risk profile, personal condition, and etc., which we will cover in this lecture. But let's explain and get into details of KYC with a scenario, like always. Let's say you work at a bank. You are a mutual fund dealing rep. Okay. One day, Rachel Green, yes, just like from Friends, rings a bell. I love Friends. I love Friends. That's why I thought it's nice to use Rachel, Ross, Monica. Um, yeah. One day, Rachel Green walks into your branch. Okay. She's a new client and wants to open an account and invest her savings. What's your job? Your job is to help her. But before you can suggest anything, you need to follow the KYC process. Okay. Let's get to this process. First of all, you need to start with the new client application form, or NCAF. Okay. We talked about it before. I know there are some overlaps, but you will learn lots of new things here. We said that in some firms, the new application form, new client application form, is same as KYC form, and in some firms it is separate. Okay. The new client application form, also called the KYC form, is the first step. This is important. First step in understanding Rachel's financial situation. Okay. So every new client must complete this form before opening an account. It's a must, it's not optional. Okay. It helps you as a mutual fund sales rep gather essential facts about your client, ensuring you offer investments that actually fit and match your client's needs. So what components this KYC form has? Okay, what information you gather from your client in this KYC form? Let's go through them. Identification. You need to verify your client's identity and check if there are any concern like fraud or other stuff. You need to collect a personal condition like age, uh, married or single, number of dependents. You need to collect financial condition like her income, expenses, job, assets, liability, or like overall financial health. You need to know your client's investment objective. Is she looking for growth or income or capital preservation? Is she going to buy a house in 5 years or planning to invest for her retirement? You need to know all of these information. You need to know her risk profile. Is she comfortable with high risk investment or does she prefer safer options and risk averse client? You need to definitely know that. And time horizon. So by time horizon, I mean how long can she keep her money invested before she needs it? Can she invest her money for 30 years or just 5 years? It really varies. If she can invest for 30 years, so you can start off with a growth, recommending growth and high risk investment because time is a lot. Time to maturity is a lot, 30 years. So uh, she shouldn't be worried about ups and downs of the market um, in the early years. Okay, so these factors, these components are very important in KYC process, and you need to collect them in the first meeting with your client. Now let's go through each of these components, starting off with identification. So the very, very first step is identification. So before anything else, you must verify Rachel's identity. What does that mean? You need to ask for government ID. Hey, Rachel, could you please hand me over your government ID? So ask her passport or driver's license to confirm her full name, date of birth, and address, and to match the government ID's photo with her. Okay, you need to do that. And then while you are looking into the government ID, you need to watch her or watch for red flags. Okay. So if something feels suspicious, like fake ID, like strange behavior, she's stressed out, your client is stressed out, this is red flag. Okay. You must investigate this further. And then you need to follow the law while you're doing the identification process. By following law, we talked about the money laundering, PCML, TFA. So, under the Proceeds of Crime, Money Laundering, and Terrorist Financing Act, PCML, TFA, you must ensure Rachel is not involved in illegal activities. Okay. Most of all, in the first meeting, we don't do that because there's no transaction, of course, to be suspicious about. But you need to you need to make sure that her ID is not fake and her ID matches her profile. Okay. Remember something here in this process. You are a gatekeeper to the financial market. Okay. If something seems off, you must report it to prevent fraud or criminal activity. So she's opening an account with you. So you are allowing Rachel into the financial market. So your job is very, very important to make sure that everything is legit and in order. Okay, great. Now let's get to the second component of KYC, which is personal condition. Now that you have confirmed her identity, let's say everything is fine with her government ID, okay? It's time to understand Rachel's personal life situation. You ask few questions to understand that, and you need to document Rachel's answer. What are the questions? Age and date of birth. Let's say she's 30 years old. This is important. Why? Because usually a 30-year-old individual is a high risk profile client because she's young, 30 years old. She has lots of time to maturity, okay? Also, you need to have her address and contact information, like home address, phone number, marital status. So is she single or married? Dependencies. Is there any kid or no? And other authorized people. Is somebody access her account? For example, if she's married, if does her husband access her account and other financial interests? These are personal condition questions that you need to ask Rachel and your client. And the most important part, you need to document everything, okay? In that KYC form. We said that your client's age is very important, but why? There are several reasons. Let's go through those reasons. Number one is legal age. She need to be over 18 so she can legally open an investment account. Okay, if she's less than 18, she needs a trustee. So we need to definitely make sure she's above 18. And then investment strategy is the second reason. We talked about it. Let's say she's 30 years old, and since she's young, she can take more risks with her investment for higher returns. Okay. The third reason is retirement planning. Uh, let's say Rachel has 35 plus years before retirement. She's 30 and retirement is 65, so 35 years till retirement. This means she can invest in long-term growth stocks or mutual funds, okay? Compare it with a new client which is 60-year-old who's retiring soon in 5 years. They could prefer safe, low-risk investments because they can't afford big losses. So this is why we are collecting personal information like age and the most important thing is here age. Age is the very important thing in personal situation. These are the reasons. So legal age, we need to confirm that, investment strategy and retirement planning. These are three most important reasons. Uh, okay, we talked about individuals here like Rachel. But what about corporations and company? Does KYC apply to corporations and companies? Let's learn that. If Rachel was opening an investment account for her company, okay, you as a mutual fund sales rep, you would need different personal situation information, okay? We're talking about personal information here, the second component of KYC. You need to collect different information, like what? Like business's name and address. Instead of um, the individual's name and address, you need to collect business's name and address. Type of business, is it corporation or trust? The legal documents like articles of incorporation or trust deeds, and etc. Okay. And you also need to collect authorized people to manage the account. Who can manage the account? Because company itself is not a human. You need a human to manage the account. And you need to name and document those um, people that are authorized to manage the account. So this is about the corporation. Now, let's get to third component of KYC, which is financial circumstances. We defined that briefly, and let's get into details of financial circumstances. Financial circumstances are key to understanding a client's ability to invest. Okay, client's financial ability. We're focusing on finance here. Here's what you will need to a- assess for Rachel or for your client. Um, Employment status and occupation. You need to know that. Okay. Annual income, how much she's making. So how much she invests on from that income. What are the expenses? You need to know that. Her net worth, her financial and liquid assets, her liquidity needs, her use of leverage, and her credit worthiness. Okay. You're wondering, okay, what are liquidity, leverage? We're going to get into details of each of them right now. Okay. So don't worry. Let's dive deeper to each aspect of financial circumstances, starting off with employment status and occupation. Let's get back to our scenario. Let's say Rachel tells you she recently switched careers from a fashion executive to running her own startup. So, this information is very, very crucial. Why? Because someone retired and living on a fixed income has different investment needs than someone in their high earning years. That's why employment status and in like current employment is very, very important. Okay. If Rachel's income is irregular, for example, she's a new entrepreneur, so there are ups and downs in her income and earnings. She may have gaps in earnings, requiring investments with greater liquidity. By liquidity, I mean investments that if she needs or whenever she needs money, she could sell it right away. She shouldn't wait for longer time. What's the key takeaway in employment status and occupation? Understanding employment status helps tailor an investment strategy that fits Rachel's income flow. Okay. Now, let's get to annual income, the second factor in financial circumstances. Rachel reports an annual income of, let's say, 120K. Why does this matter? Because clients with low income usually need to preserve their principal and require more liquidity because they may need to access their money fast. So they need to invest in something that they could sell faster and get their money and put it and use it whenever they need. Okay. But higher earners, like Rachel in this case, she's making 120. Let's assume she's making 120K. Higher earners can typically tolerate more risk since they have a financial relief. She's making 120K. So she's having a good saving and she's making a good money. So if she lose some money in the early years of investment, she would be fine. She could use her savings because she have lots of money. And that's why, guys, here is the sad part. That's why rich people get richer. Why? Because they can tolerate more risk. Why they can tolerate more risk? Because they have good amount of money, so they don't worry about the risk. If they lose it, okay, they lost it. That's why they're getting more successful. And I feel like this is not fair. They have money, so they could risk that money, and if that risk pays off, so they get richer. And if that risk doesn't pay off, they just, you know, lost a tiny little part of their money. Okay, let's get back to our course. In KYC form, there is an important part of documenting annual income of your client. Okay, in KYC form, you don't document the exact number. Instead, you record your client's income in ranges. Like what? Let's say less than 70K. You check if Rachel is making less than 70K, you check that box. Or 75 till 100K. 100 to 199. So it goes like this in a range, okay? What's the key takeaway in annual income aspect of financial circumstances is Rachel's income suggests she may have some risk tolerance, but still needs protection against potential losses. Great. Now let's get to net worth, the third aspect of financial circumstances. Rachel owns a condo worth 500K and has saving of 100K, but she also has a mortgage of 300K. Okay, so 300 out of that 500K condo is mortgage. Okay, so we need to calculate. I mean, by we, I mean you as a mutual fund sales rep, you need to calculate net worth of your client in that KYC form. Okay, so net worth, the formula is liquid assets plus fixed assets minus liability. This is very, very important formula, by the way. Okay, just try to learn it. What do I mean by liquid assets? I mean her savings. Why it is called liquid? Because she can access it right away. It's in her savings account. She can withdraw it in a day, in one business day. Okay, she doesn't need to do any transactions. She just go to bank and withdraw that 100K. So it's liquid. It's not solid or gas. It's liquid. Okay, you get the point here. So 100K is her liquid assets, and we said that she has a condo worth of 500K. This is fixed assets. So 100 plus 500, 600 in assets. But we said that 300 of that 500 asset is a mortgage. So it's a liability. She needs to pay back to the bank, for example. Okay, so we need to deduct that amount. And so her net worth will be 300K in total. And just like the income, we said that income is recorded in range. You don't need to get a calculator and calculate everything. No, it comes in range. Okay, you need to check boxes that fits your client's range. Exactly, like less than 50K or 50K to 100K. You need to check every box that fits your client. You don't have to record exact number here. The fourth component of financial circumstances is liquidity needs. We defined liquidity, but let's redefine it here. Liquidity means how quickly Rachel or your client can convert investments into cash. Okay. um, so how do we know what liquidity needs does my client have? You need to ask some questions to Rachel. What are those questions? Hey Rachel, do you need access to your funds in the short term? Or do you have major planned expenses like buying a car or business funding? Do you have an emergency fund separate from your investments? These are the questions you need to ask to make sure that, like, how is your client's liquidity needs? Okay. Because it really affects the strategy, the investment strategy you would choose for your client. What's the key takeaway here? If Rachel needs access to her funds soon, so high risk long term investments may not be suitable. Not may, it definitely not be suitable, okay? Great. Let's get to leverage, the other aspect of financial circumstances. Leverage, in simple terms, means borrowing money to invest. Okay. You don't have that much. I mean, let's say you want to invest 100K. You have 70K from yourself. You borrow the rest, that 30K from a friend or whoever, like, and so this activity is called leverage. Leverage means borrowing to invest. Okay. So Rachel asks if she can borrow money to invest. You may say, okay, nobody can borrow money to invest. No, you're right. You must evaluate some things here. You must evaluate what? You must evaluate the net worth. If she has a good amount of net worth, yeah, definitely she can borrow money. Okay, by net worth mean, can she handle extra debt? Liquidity net worth means, does she have enough accessible cash? Total debt service ratio, or TDSR. TDSR shows how much of her income goes to paying debts. Okay. Those who are mortgage agents, they calculate TDSR for every client. How much of the income goes to paying debts? Percentage of net worth invested in loans. It means, is she taking too much risk? Okay, so these are the factors that you need to evaluate before saying yes or no about a leverage that your client do. Okay, so for the sake of our example, if Rachel's financial situation doesn't support leverage, you must discourage her from borrowing to invest. What's the key takeaway here from leverage? Leverage isn't for everyone. You need to consider that, okay? Only and only clients with strong financial backing should consider it. If a client doesn't have net worth, like high net worth, she shouldn't, or he shouldn't, your client shouldn't use leverage and borrow money to invest. Let's get to fourth component of KYC, which is investment needs and objectives. Investment needs and objectives tell us why Rachel wants to invest. Why? Okay, it answers the why. And what she hopes to achieve with her money. Okay, it answers these two questions. So every client has different goals. Some want safety towards inflation, for example. Others want growth. They want to put, for example, 10K and get 20K in 3 years. So they want growth. Okay. And some are willing to take big risks for high returns, like very, very big risks. Okay. Your job as a mutual fund sales rep is to match investments to the client's needs. That's the most important part of your job. Based on the needs and objectives of your client, you can recommend different products or different types of investments. Okay, let's go through those different products or investments by our example, which is Rachel's. Okay, number one is safety of capital or safety of money. Okay, let's say Rachel says, I don't want to lose any money. I just want my money to be safe. Okay, when you hear this from your client, it means your client is looking for safety of capital. Okay. So what you suggest and recommend, you suggest low risk options. What are low risk options? Like GIC, okay, or guaranteed investment certificate, and just savings account, cash, put it in a cash, or money market investments. These are a very low risk investment options that you need to recommend to your client if they just want safety. Okay, these ensure her money is protected by they don't grow much. Okay, so money market, cash, or GIC, these are the safe ones. But you may be asking, okay, what if Rachel has high net worth? So when we are evaluating KYC of the client, we just don't focus on one factor, high net worth. No, we need to look at collectively. So Rachel in here in our case is looking for safety of capital. So she's a risk averse person. She cannot tolerate risks. She doesn't want to tolerate risks. Okay, so she's a low risk profile. Okay, I know she has a high net worth, but we need to consider all factors in KYC when deciding and go for the lower of all of these factors. Okay, so the first objective of the client could be safety. Let's get to the second objective. Clients may look for income. Okay, Rachel may ask you, I want to earn a little extra money regularly from my investments. So, whenever you hear this statement and line from your client, it means they are looking to get income from their investments. Okay. Do we have investments that offer incomes? Of course, we do. Those investment types are fixed income securities like bonds, like debentures, okay, or dividend paying stocks like preferred shares, and some money market funds. These are some, not all of the money market funds. These are the investment types that pay your client, in this case, Rachel, periodically while keeping the risk low. Okay. The third objective of your client could be growth. Okay. Rachel may ask you, I'm okay with some risk as long as my money grows over time. Okay. Whenever you hear this statement, it should rings a bell of growth. What are the investment types that offer growth for your client? Stocks or common shares are the most known and well-known growth type of investments. Okay, it could be Canadian equity or US equity and international equity, it doesn't matter. But growth come from these stocks when you buy stocks, or equity mutual funds. Okay, mutual funds that invest in the equity. Most of the investments is in equity. We will definitely go into details of fixed income securities, bonds, equities, money market, everything, every investment type that I mentioned here, we will cover it in future chapters. So do not worry at all, okay? You just need to know the connection here and have the holistic and bird view on these. The fourth type of an objective of your client could be balanced. So Rachel may ask you, I want a mix of growth and income. Okay. So some stability, but also some returns. What are the investment types here? A mix of fixed income and equity investments like bonds and stocks. This strategy balances security with potential growth. It's self-explanatory, balance. So it is mix of number 2 and number 3. The last objective of your client could be aggressive growth or a speculation. Rachel may ask you, I want big returns, very, very big return. Okay. And I'm okay with taking big risks, because if you want big return, you need to take big risks. Big returns doesn't come with investing in bonds or money market funds or putting it in savings or GIC or buying GIC. No, you need to buy, for example, derivatives or hedge funds, or these offer big returns. But you need to consider that with big returns, big risks comes. Okay, big risks come. What are the investment type? High risk investments like emerging markets, technology stocks, natural resources, venture capital funds, and hedge funds. These have high potential, but can also lead to losses. Now that we know different objective of clients, it could be safety, income, growth, balanced, aggressive growth, speculation. These are different objective of your client. So I do have a question from you. Do you think your client, or Rachel in our case, can have multiple objectives? Yes or no? You got 3 seconds. Three, two, one. And the answer is yes. So many clients, like Rachel, have a mix of goals. What do I mean by that? I mean, maybe she wants 50% growth and 50% income. Okay. The KYC form usually shows clients to assign percentages to different objectives to reflect their priority. Okay. So, so let's say they have 50K to invest. They may, in a KYC form, they may say that, okay, 25K for income, and the rest 25K, I don't need it, just put it in a high risk investment. Okay, they can split that. So the answer to the question of can Rachel have multiple objectives is yes. Okay, we now know the different types of objectives. And the question here is, how do we document investment needs? Okay, we said that when filling out the KYC form, we should use simple language so clients understand. Okay, regulators like Ontario Commission or provincial regulators require investment goals to be specific and measurable. So here's are the examples that how we might document Rachel's objective. We might write down that, okay, save for retirement. Simple language, okay? Everybody understands that. Grow wealth by 20% in 5 years. It's measurable. We have 20%, we have the time horizon, which is 5 years. Or invest for a future home purchase in, let's say, 10 years. Save for her kids' education in 15 years. These are the ways that we need to write down and document the needs and goals and objectives of our clients in simple language. This simplicity helps ensure we pick the right investment strategy and keep her updated on progress. Get to fifth component of KYC, which is investment knowledge. So, what is investment knowledge? Investment knowledge refers to how much a client understands about investing. Okay. This includes financial markets, different types of investments, risk levels, and how they affect returns. So, uh, it definitely matters. When you recommend something to your client, let's say you say, we will invest 20% of your savings or whatever you want to invest in equities. The end client doesn't have any idea what equities mean. He or she just will say or agree to your recommendation without knowing what equity means. Okay. You definitely need to know the knowledge of your client. So it helps you to describe more, okay, what equity is if your client doesn't know it, or if he or she knows have a good knowledge of investment and financial market. You don't need to explain everything over and over again from scratch. Okay, your client understands the recommendation that you are offering. So why does knowing investment knowledge matter? Because knowing your client's investment knowledge helps you recommend suitable products. Someone with low knowledge may not understand high risk investments, while someone with high knowledge may want advanced options. Let's get back to our scenario and Rachel Green. You ask Rachel about her experience with investing. She says, I've heard about the stocks and bonds, but I have never really invested before. So, on the KYC form, you need to tick the box that says low investment knowledge or novice. Okay? Here's the important point about investment knowledge. Just because someone has investment experience doesn't mean they have investment knowledge. So, investment experience is different from investment knowledge. Okay. So, some clients may have made lots of money through investments, but it still doesn't know how they work. Okay. They just put the money there and it has been grown up and up, but they don't know what stock is it or what fixed income is it. They have no idea. So, experience doesn't mean knowledge. You need to defer that. Let's get to sixth component of KYC, which is time horizon, and very important concept and component of KYC. A short time horizon means your client, or Rachel in our case, need the money soon. And a long time horizon means she doesn't need the money soon. She has lots of time. She can leave it invested for years. Now, let's get back to Rachel. You ask Rachel, so when she plans to use her investment money, she says, I want to buy a house in 3 years, so I'll need my money then. What does this mean? This should rings a bell in your mind, okay? This means Rachel's time horizon is 1 to 3 years or short term to medium in the KYC form. In KYC form, you need to check the box that says 1 to 3 years or short term. It is different in different firms, but you need to check that box. So, why is time horizon important? Because if a client like Rachel has a short time horizon, we talked about it, it would be unsuitable to put her money in high risk or long term investments that may fluctuate in value. So let's have an example of unsuitable investment based on time horizon for Rachel. For example, if you suggest a 7 year locked in bond, it wouldn't work with Rachel's need because she needs her money in 3 years to buy a house. Let's get to the seventh component of KYC or Know Your Client, which is very, very, very important, and it is called risk profile. A risk profile determines the suitability of an investment product for Rachel. Okay. So, risk profile consists of or includes two key factors. Very, very important: risk tolerance and risk capacity. What's risk tolerance? Risk tolerance means how much risk your client willing to take. Tolerance, willing to take. And risk capacity is how much risk your client is able to take. So willingness and ability. Okay. Tolerance means willingness. Capacity means ability to take risk. So here is the most important part and point here. Risk profile of your client is based on the lower of these two factors. What do I mean by that? So, if your client has high risk tolerance and high risk capacity, your client is a high risk profile. It's fine. Okay. And we know that if your client has low risk tolerance and low risk capacity, so your client is a low risk profile. Simple. Both of them were high and both of them were low. But if one of these factors of risk tolerance and risk capacity is low, the risk profile of your client is low. Okay, we don't care about the other factor because the risk profile is based on the lower of these two factors. If one of them is low, so your client is a low risk profile. Now, How do we assess Rachel's risk capacity? By capacity, we said that it is Rachel's ability to take risk. To determine Rachel's risk capacity, you need to look at her financial situation. Okay, you need to see and know that does she have a stable salary and income? Does she have loans or credit card debts? What about the assets? What is her net worth? What about her liquidity needs? Does she need quick access to her money? Her age, her life stage. Is she young with time to recover losses or near retirement? Investment knowledge. Is she a beginner or experienced investor? These all determine the risk capacity of your client, okay? All of those 6 components that we talked about so far about KYC, they all need to be evaluated collectively to determine the risk capacity of your client, okay? For the sake of this example and scenario, let's assume Rachel is 30 years old, single, and has 50K in savings and makes like 60K um, a year, a month, no, a year. Based on her profile, she might have a medium risk capacity because she's making 60K, okay? So medium risk capacity. Great. It's time to categorize risk profile. I mean, knowing different risk levels and what type of investment match with that risk level. Okay. We're going to dive into risk profile categorization. So, banks and investment firms classify risk profiles into different levels. Let's get into the simple breakdown. In the first column, we have different risk levels. In the second column, we know that who is this risk level for. And in the third column, we have the investment type that matches those risk levels. Let's start off with the first row, which is low. If so, low risk level is for conservative investors. Okay. What type of investment suits conservative investors? GICs, savings account, money markets. We talked about it. We covered it. And keep this in mind that we do have a dedicated chapters to go through different types of investments and those different types of investors. So don't worry, okay? We're going to cover in details. Here, you need to have a bird idea. You need to build a foundation here, a little bit of foundation here. So understand that when a client has a low risk profile, it means your client is a conservative investor, okay? He or she doesn't want to risk conservative, self-explanatory here. So the type of investment that matches your client is GIC, savings, and money market. For low to medium risk level clients, those clients are called balanced investors. Okay. What type of investments are good fit for them? Bonds, balanced mutual funds are a good fit for these types of clients with low to medium risk levels. Then we get to medium risk level. Okay. These clients are called growth-oriented investors. So blue chip stocks or dividend funds and preferred shares are a good fit for medium risk level clients, which are called growth-oriented investors. Then we have medium to high. Those clients are called higher risk tolerance clients, okay? What type of investments are a good fit? Small cap stocks, sector specific funds, okay? And the last risk level is high. So these clients are called aggressive investors. By aggressive, I don't mean angry investors. Aggressive, I mean those who really have high risk profile and high risk tolerance and capacity. Aggressive investors. This is exactly opposite of risk averse or conservative investors. Okay. What type of investments are a good match to high risk profiles? Emerging markets or hedge funds or commodities or derivatives. These are a good match for these types of investors. This is a very, very important table. Okay, please, you can feel free to pause the video and go through them again so you know the names and different types of investors and investment types that match them. And again, please don't feel overwhelmed because we're going to cover, we do have a dedicated chapters to these topics. Let's get to concept of risk versus return. Um, let's say Rachel now asks and says, I want to make a lot of money fast. Okay. Here's exactly when you need to educate your client on risk versus return. You need to say that, hey, Rachel, higher returns come with higher risks. And lower risk means lower return. You can't expect higher return with low risk. No, it doesn't work like that. So if Rachel still insists on high returns but isn't comfortable with risk, you should explain alternatives. What are the alternatives? Means saving more money instead of taking high risks, investing for longer time horizon. We know that risk and return can be used even interchangeably. Higher risk means higher return and lower risk means lower return. Let's get to the documenting risk profile part. Okay, we now know the risk profile of our client. How do we document it? So your client's risk profile must be recorded in your client's KYC form. We know that. Okay. If there is a mismatch between what she says and what she can handle, you must document it and protect her from a risky decisions. So if she has a willingness to take risk, so her risk tolerance is high, but her capacity to take risk, her ability is low, we said that we go with the lower one. Her risk profile is low, although she's willing to take risk, but she doesn't have the ability. So you need to educate your client and avoid from risky investments. Okay. So why the documenting risk profile is important? Because if the wrong risk profile is assigned to a client, it can lead to client complaints, regulatory actions, and legal issues, which makes sense and fair. Okay. You have to do your job very good when acquiring these details. You may have a question and say, okay, does this risk profile stays forever, like constant, fixed, no changes in risk profile of clients? No, there will be some changes. So let's elaborate with a real life example. Rachel's risk profile is not permanent. Why? Because life events can change it. So let's say Rachel loses her job, so her risk profile might drop to low because her ability to take financial risks has changed. So if the Rachel's risk profile was, let's say, medium, and if she loses her job, we need to update that risk profile and categorize Rachel as a low risk profile client. Now, we have documented the 7 components of KYC. You did a great job documenting all information about Rachel. But there are some points here that we need to consider. Actually, there are 5 points that we're going to cover in this slide here. Point number 1, clients with multiple accounts. This may happen. So now, let's say Rachel tells you she also wants to open another account just for retirement savings. Okay, this is great. Okay, she wants 2 different accounts. So what happens here? Each account serves a different purpose. So you must collect separate KYC information for each account. Okay. Why? Because the risk level for each account may be different. The time horizon will be different. If she has a account for retirement, her time horizon is long. But if she wants an account for, I mean, the whole purpose of account is buying a house in 5 years, her time horizon is short. So each account, this is very important, each account has their own KYC information. Okay. So, for example, account one is down payment savings. So it is need to invest in a low risk investment types. Account two is retirement savings. So it can start with higher risk investment types. And then when when it nears the maturity, it can change the asset allocation to lower risk profiles. So this ensures Rachel's investment match her goals and time horizon. Point number two is joint accounts. So let's say Rachel returns another day with her brother, Ross, to open a joint account. Okay. Uh, Here's what you need to do. When did I say brother? I mean her husband, Ross. In joint account, there is an important point. You need to collect KYC information for both Rachel and Ross. Okay? Very, very important point. Both parties need to fill out the KYC form. And they can decide whether to report their account, whether to report their income or net worth separately or combined. They can decide this. Okay? And obviously they should have same investment goals in a joint account. You can't have two investment goals in one account. No, it doesn't work. And they need to have um, risk tolerance, same risk tolerance. Okay. So because it's just one account. When we're talking about I know that one account is a joint account. It's for two people and we're collecting information about two people. But we at the end of the day, in that KYC form, we need to check one box, okay? One risk profile, one time horizon, one investment goals, just one thing, not two and individual things. And joint accounts must be handled carefully because both owners make investment decisions together. So very tricky when we're dealing with joint accounts. The third point is KYC confirmation. Let's say uh, the Rachel's account is set up and everything looks good, but your job isn't over yet. What do I mean by that? I mean, you must confirm with Rachel that all her KYC details are accurate. And if anything changes, like income or investment goals, she must update her KYC. She must give you a call and say, "Hey, I just lost my job or my income has been increased 20%." Okay? Just consider it in my KYC. And you must provide her a written confirmation of any updates. She should be given a chance to correct any errors. So we need to go through the KYC confirmation. The fourth point about KYC is keeping KYC updated. Okay. There is a timeline. Rachel's life will change over time, and so should her KYC. If she gets married, her financial goals may change. If she has kids, she might want to save for education. If she buys a home, she may want less risk. If she gets a new job, her income has been increased. So her life is changing. So you need to update her KYC over time. But here's the takeaway. As her financial advisor, you must update her KYC at least every 36 months or anytime there is a major life change. So, if before 36 months or 3 years there is a big and major life change, you have to update her KYC. But if nothing new happens, you must call her and have a meeting with her every 36 months to go through all the details over and over again. Okay? The last point, what if a client refuses KYC? What if she doesn't provide you her information, those 7 components? What do you do here? Let's say Rachel wants to open an account but refuses to give her KYC information. She says, "It's my privacy. I won't give you anything. No, don't ask me questions." You will face these types of clients. Here's what you must do. First, you must explain why are you gathering this information and why KYC is needed. You need to say it protects her, your client, and ensures proper investments. After explanation, if she still refuses and insists that, hey, it's my privacy, I won't give it to you, you cannot open the account. So she can't force you to open an account. No, you need her KYC. You cannot open an account. It's illegal, okay? You may need to report it to compliance or even FinTrack if suspicious. Why would a client wouldn't give her information? It's suspicious. It's rings a bell. It's a red flag. You need to report it to the compliance department, and then compliance department will report it to FinTrack. Because KYC at the end of the day is helpful for the client. Why would the client refuses to do that? So KYC is a legal requirement, and without it, no account can be opened. That is very, very important. Great. I'm sorry that it was a very, very long lecture, but we covered tens of pages in the textbook, and I needed to include all information. And the most important part is we are learning it together in a way that you are actually a financial advisor or mutual fund sales rep, okay? It's a practical way of learning things. You need to close your eyes and imagine yourself in that role and then go through this process again. Okay. I'm trying to not prepare you only for the exam. We will crush that exam with 90% plus. Don't worry about that. I'm also preparing you for the real life role of mutual fund sales rep. So please forgive me if lectures are so long. I have to cover everything. Go crush the next quiz, and I'll see you in the next lecture. And thank you for your trust, by the way.